Okay, so picture this. You've got a company right at the very heart of the AI revolution. It's growing at this absolutely mind-bending pace, signing huge deals with the biggest tech companies on the planet. You'd think its stock would be just rocketing to the moon, right? Well, what if I told you that's not at all what happened? Let's dive into the super curious case of this AI powerhouse. Right, this is the big mystery we're going to unpack here. I mean, on paper, this company's earnings report should have been a launch pad, but instead, investors got spooked. So what on earth did Wall Street see that all the big headlines seem to miss? And honestly, it gets even more confusing when you look at the actual numbers. Get this, revenue growth of a whopping 355%. They landed a massive $3 billion deal with Meta, and they signed a deal with Microsoft that could be worth almost $19.5 billion. I mean, these are incredible wins. And still, the stock sold off. It's a total paradox, and that tells you there's a much deeper story going on here. So, to really get to the bottom of this mystery, we first need to understand the company at the center of it all, Nebius Group. The easiest way to think about Nebius is that they're selling the picks and shovels during the AI gold rush. They provide that fundamental, super high-performance computing power that pretty much every company needs to build, train, and run these gigantic AI models. They are quite literally building the foundation of this new world. And here's the thing, they're not just a one-trick pony. Nebius has built this entire ecosystem. You've got Nebius IA, which is their main cloud platform. Then there's Toloka, which handles the crucial task of labeling data for AI. They even have 1010 for training up new AI talent, and Avride, which is their big moonshot bet on self-driving cars. It's the whole shebang, an integrated approach that's designed to capture value from every single angle. Okay, so now let's talk about the bull case, the really positive side for the company. Because these growth numbers are, well, they're just explosive. First off, that top-line growth, a jaw-dropping 355% year-over-year in just the third quarter. Look, this isn't just strong growth, this is hyper-growth. It's a massive signal that demand for what they're selling is absolutely white-hot. And then, you look at who's buying. They just inked a $3 billion five-year contract with Meta. Come on, when one of the biggest companies in the world trusts you with their core AI infrastructure, the rest of the market really sits up and takes notice. And it doesn't even stop there. They also landed this multi-year deal with Microsoft that could be worth up to $19.4 billion. This isn't just another contract. It's a huge strategic partnership that basically validates their entire business model. And you know their ambition matches the deals. The company is shooting for up to $1.1 billion in annualized revenue by the end of 2025, and then an incredible $7 to $9 billion by the end of 2026. So they're not just growing, they're planning for some truly world-changing scale. And this quote from Guru Focus pretty much says it all. They're selling out of every last bit of computing power they can bring online. Demand is clearly not the problem here. So if everything is so great, what is the problem? And this right here is where we find the big twist in the story. This is the reason investors are hesitating. It's all about the capacity bottleneck. See, to meet that crazy, insatiable demand, Nebius has to spend. And I mean, they have to spend money on a scale that is almost difficult to wrap your head around. So here's the crucial number. They just raised their spending forecast for 2025 to around $5 billion. That's $5 billion just to build out data centers, buying land, buying hardware, all before they see any single dollar of revenue from any of it. And that kind of spending has a very direct impact. In 2024, the company burned through more than $1.1 billion in cash. This is the high burn part of our paradox, and it's a number that makes any investor, well, very, very nervous. This chart here really lays out the bear case, the negative view, in pretty stark terms. You've got that massive cash burn, which is almost half the concern. Then there's the risk they'll have to sell more stock just to fund all this expansion. That's another 30% chunk of the pie. And finally, you have widening net losses. This is the tough financial reality hiding behind all that explosive growth. So, how does this strategy really stack up against the competition? Is Nebius building a real long-term competitive advantage, what they call a moat, or are they just taking on a ridiculous amount of risk? Let's compare Nebius to a key competitor, CoreWeave. This table shows you two completely different ways to bet on AI. You've got Nebius building a full-stack platform with really sticky software and these beautiful 70+% gross margins. Then there's CoreWeave, which is more like a pure GPU rental service. They're focused on raw scale, But wow, look at their gross margins. They've collapsed to just 2%. One is building a fortress, the other is just chasing pure speed.
And this right here perfectly explains the core difference. CoreWeave sells you access to computing power. If a competitor comes along with a better price, their customers can just pack up and leave. But Nebius sells you an entire platform. Once a customer builds their AI models on top of the Nebius software stack, switching becomes way harder and way more expensive. That's what you call product stickiness. That's a real moat.
So when you piece it all together, what you're really looking at is a massive, multi-billion-dollar gamble on the entire future of AI.
This is the entire Nebius story in one chart. On the one hand, you have that incredible revenue growth and really healthy gross margins, which proves their model actually works. But on the other hand, you have this deeply negative cash flow because of the insane amount of investment required to get there. This is the fundamental trade-off at the very heart of the company.
So what does the path forward look like? Well, it's a bit of a high-wire act. Step 1, pour billions into building out capacity. Step 2, lock in that capacity with giant long-term contracts from guys like Meta and Microsoft. Step 3, scale your revenue so fast that it outruns all your spending. And then the final and most crucial step, actually become profitable before all that cash you raise runs out.
And that's really what this all boils down to. It's a race. It's a flat-out race to build a durable, profitable, foundational AI company before their huge war chest of investment money is completely gone. The stakes just could not be higher.
And that brings us right back to our central question. Is this the story of a company building a sticky, high-margin empire right at the center of the AI universe? Or is this just a spectacular growth story that's simply burning too bright, too fast, and is about to burn out? The answer to that is going to define a major player in the next decade of tech.